Hello, welcome to the Bluff Books podcast. This is hashtag Bluff Books, the show that's all about building, leading, and understanding financial freedom. So whether you're an average Joe seeking financial well-being and independence, or a fiduciary advisor who seeks to connect with average Joe, thank you for joining me on this show as we discuss books relating to the topic of financial literacy. And don't forget to hit the subscribe button so you can continue to enjoy a new episode with me every week. I'm your host, Ian Gates, a former Spanish teacher and U.S. Army intelligence officer, but now I'm an aspiring financial advisor because as a teacher and an intel officer, my soldiers and my students constantly had financial questions, and when they'd ask me, I'd have to say, I don't know, I have to look that up too. And so the show's name comes from the military acronym BLUF, which stands for Bottom Line Up Front. It means that here I seek to always present the most important information right at the start in the clearest, most engaging way possible. Like my hero LeVar Burton of Reading Rainbow fame, my goal is to encourage a love of reading, and for this show to be a springboard, not a stopping point for your engagement with these texts. And please remember, this is a radio show, so we can only discuss concepts in terms of general truths and tendencies. It is for educational purposes only and is not financial advice. Thank you, and let's start the show. Hello, everybody, and welcome to today's episode of the Bluff Books podcast. In this very first show, we'll be discussing the book The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. It was written by Eric Balchunas, who is a senior ETF analyst for Bloomberg, and it was published in April 2022 by Ben Bella Books. So per the show's name, let's present the bottom line up front. These are the four big ideas that captured my attention when I read and reread the text. So, first point, who's your daddy? Who raised the humble index fund into the juggernaut it is today? 2, costs matter. Never underestimate the power of a single decimal place when it comes to compounding your wealth. Number 3, by the people, how John Bogle democratized investing. And number 4, don't just do something, stand there. The beautiful power of inaction. Let's get started. So number 1, who's your daddy? So in the world of investing, John C. Jack Bogle is widely called the father of index funds. And while he didn't invent them, and early in his career he was actually opposed to the idea, he came around and, as arguably the adoptive father of the index fund, he raised it to be one of the biggest kinds of investments out there in terms of sheer amount of money put in it. The firm he started, Vanguard, is actually, depending how you measure it, either the biggest or second biggest asset manager in the United States and the world right now, with the other titan of the industry being BlackRock, and then a whole lot of nothing, and then the rest of the pack with everyone else, your Victory Capital, T. Rowe Price, Charles Schwab, etc. And of course, Eric Balchunas, he's a huge fan of Jack's, but he tries to present a 3D picture of the man, including some of his mistakes and shortcomings, and really be honest about him and his legacy, though on the whole, as Eric says, the net positive for your average person saving for retirement, your average person trying to build financial security, is really huge. So what is an index fund? So an index fund is a type of mutual fund that tracks an index. So an example of a famous index is the S&P 500, which is a league, I guess you'd say, of stocks that are selected and unselected by Standard & Poor's according to a set of criteria or rules. So while an active fund manager relies on their expertise, their experience, and their insight to try to buy funds that will exceed the market average, an index fund simply tracks the market average for that category. And the beauty of an index fund is that it's easy to automate and it's more reliable over the long haul. You're not putting all of your risk in one place. It's very diversified. And so I would compare it to fantasy baseball as opposed to actually being the manager of a team or the general manager of a team. So I don't have to invest in Derek Jeter. I don't have to invest even in the New York Yankees. I can invest in, say, the entire American League East. And while diversifying my risk quite a bit, I can enjoy the steady Eddie dividends over a long time as the American League East goes to the World Series, I would say probably more often than other divisions in baseball. And so by automating your funds to just reflect the market, you enable costs to be driven really, really low. So that leads us to our second point. Costs matter. So Bogle was once an active fund manager, and when he became a convert to index investing, he looked around at his peers and saw the fees that were normal to charge for the relative unperformance of those active funds. And he looked at the industry as a whole in financial services and said, index funds are really simple and really easy to run. There is no reason we should be charging an arm and a leg to do it. It's just follow the basic rules of what qualifies or disqualifies a share from the index and then just buy and sell accordingly. So the other insight of that was you can't predict what the market is going to do. I mean, you can generally look at historical trends of going up, but there's volatility, which is what makes the line jagged. There's peaks and valleys like a roller coaster. But by reducing fees, you can guarantee a better performance over an identical fund that has higher fees. So you can streamline, you can reduce the drag of the fees and free up more money to be reinvested in the fund over the long haul. And the impact can be massive over time. So during the 70s, the financial services industry norm for fund expense ratios was around 0.80. And today, most of our garden variety Vanguard funds are somewhere between 0.04 and 0.30. And other firms have been forced to keep up, create their own Vanguard knockoff funds with similarly low expense ratios. And an expense ratio, just for a little bit of context, a 0.05% expense ratio on a fund is $5 in fees per $10,000 invested, whereas a 0.50 expense ratio is $50 in fees per $10,000 invested. And so that can really accumulate over time. And next, our third point, so by the people, for the people. So one of the things that makes Vanguard very weird in a good way is that it is owned by its funds, which are in turn owned by the owners of the funds, the investors. And so Vanguard is internally incentivized to keep costs very low, whereas by contrast, other firms in the industry are either publicly or privately owned. So, Charles Schwab asset management firm is generally low fee, but it's still a publicly traded stock. So they answer to the owners of their stocks, not necessarily of the funds that they take care of or house. And Fidelity Investments belongs to the wealthy Johnson family. It's privately owned. So at the end of the day, Fidelity is beholden to what the Johnson family wants. But the fact that Vanguard is able to be a cooperative is less a matter of noble virtue and more the result of a unique moment in time. It was a scorched earth boardroom tactic when Jack was the CEO of Wellington Capital in the early 70s. There were two factions, the Philadelphia group and the Boston group. The Boston group wanted to stick to the status quo and rake in high fees. and the Philadelphia group, aligned around Jack, wanted to reduce fees and innovate. And so in the midst of this civil war, making it a cooperative was kind of a, if we can't have it, you can't either sort of strategy. So while later Jack may have talked himself up a bit as a saint or portrayed himself in a bit too rosy a manner, the impact on investors is undeniably positive. And that leads us to our next point. So don't just do something, stand there. Now, during the Wellington Capital Civil War of the early 70s, before John started Vanguard, I think it was 1974, status quo was the enemy. But in the case of index fund investing with low fees, status quo is actually your best friend. The status quo bias refers to the behavioral economics tendency for human beings not to make changes, to just stick with the routine. And if you set a good routine for yourself investing, especially if you can automate your contributions to boring index funds, you can really build up a substantial nest egg over time and just take the willpower out of the investing equation. You don't have to muster up the courage to invest every month. You just get used to not having that $100 a month, that $200 a month, that $500 a month. And if you get raises and you say, I'm going to put all of my raise or half of my raise or a quarter of my raise into investing over time, you avoid lifestyle creep. Getting a house with an extra bedroom just because you can, getting a more luxurious car just because you can, as opposed to investing for your future and creating cash flow. So this strategy of dollar cost averaging, if I have $100 a month automatically invested, then I have every month that $100 either buying shares at $20 a month, so 5 shares a month, and next month, say the share price goes up to $50 a share. Well, okay, I buy 2 shares next month, and then the share plummets to $1 a share the following month, and I buy 100 shares. And so the result of that dollar cost averaging is that you buy at a discount way more many shares when it's low, and you buy fewer shares when the cost is high. And by doing this steady Eddie strategy, you can really beat the pants off of almost all active funds. All right, so in conclusion, just revisiting our 4 big points. So number 1, who's your daddy? John Bogle made index funds into the juggernaut they are today. Number 2, costs matter. Don't underestimate the power of a single decimal point. The difference between a 0.5 and a 0.05 fund is huge. By the people, Vanguard's a weird firm in a good way, by being owned by its funds, and the funds are owned by its investors. And number 4, don't just do something, stand there. Automating your monthly contributions into your conservative investments can be a very helpful strategy. All right, so again, thank you for joining me on today's episode, and I look forward to sharing with you another book next week. Take care. Thank you for listening to today's episode of the Bluff Books podcast. We look forward to you joining us again as we continue to explore the world of finance, investing, and wealth building by reading new and classic books pertaining to financial literacy. And please remember, this is a radio show, so it's for educational purposes only and is not financial advice. But if you need financial advice that is relevant to your unique personal situation, please consider hiring a certified financial planner who works on a fee-only basis. The big ideas I cite here from the books are based on my interpretation of the texts, and I look forward to hearing from you and engaging with you on your thoughts and recommendations. You can best reach me by joining the #BluffBooks group on LinkedIn or emailing me at ian.gates12@outlook.com. And remember, here at #BluffBooks, we cite sources, keep it brief, treat others with respect, use humor, promote freedom, and of course, don't bury the lead. Take care, guys.